Hi everyone, Scott Williams with Aline Capital here. Today I want to talk to you guys about rate caps, the expiration of rate caps, and also escrowing for new rate caps. For those of you that aren't familiar, most of the time when you enter a floating rate loan, the lender will ask you or require you to purchase a cap on that interest rate. And what that is it's a hedge in the market where you are actually purchasing a cap that your interest rate cannot go above for that time. Now the reality is the interest rate does go above it, but the cap provider on the other side or your swap partner on the other side actually starts making up the difference in the debt service for the rate you capped it at and then the actual rate that the floating rate has gone to. So that's besides the point for this conversation. Just wanted to define it for you a little bit, but specifically today I want to talk about expiring caps and the escrows for new caps. Now, when we enter these floating rate deals, rarely ever do we purchase a rate cap that also matches the duration of the loan term. Now, for some of you that might be in shorter term floating rate bridge loans, keep in mind if you are looking to get an extension on that loan, maybe you had a 2-year loan with a 12-month extension or a 3-year loan with an extension option. Maybe you did have a rate cap that lasted that first 2 or 3 years, but you might need a cap or a new cap if you enter that extension period. For those of you that entered 7 or 10-year floating rate deals, maybe we even purchased a 2 or 3-year cap out of the gate to keep costs lower. But what I want to speak to you guys about today is keep in mind and keep an eye on when those caps mature. Basically, if you bought a 2-year cap and you're in a 7-year loan, that cap is going to mature in 12 months out from the maturity of that cap. The lender is going to start to escrow for a new cap because typically your loan documents require that unless you are covering at a certain amount or below a certain leverage point, you will have to have a cap in place for the duration of that loan. So I said 2 years earlier, but let's talk about maybe you even had a 3-year cap in a 7-year loan. So at the end of month 24, your lender is going to start escrowing for a new cap, and just want you to be aware of those if you're not anticipating additional escrows, because right now when we 2019, 2020, even into 2021, when we were purchasing rate caps, those caps really only maybe cost 1/4 or 1/2 point of the entire loan size. Whereas now, given the volatile rate environment and the increase in rates we've seen, caps are costing anywhere from 1, 2. We've even closed a deal where the rate cap was 3 points of the loan amount. So for those of you that aren't expecting it, getting the rude awakening of all of a sudden your lender escrowing 3% in just 12 months of your annual loan could be debilitating to your cash flow. Now, all that is to say, it may not be the end of the world and there may not be an action item. A case study we're looking at right now is we have a client whose cap is expiring towards the middle of 2023. And the lender reached out to him and he was not expecting these escrows. They decided they're gonna escrow at 125% of the anticipated cost, which is right around 2 points on his entire loan balance right now. That said, he's currently driving cash flow, and a refinance into something right now would actually create a cash in event. So we analyzed it with him and took a look at it with this client, and our advice was the escrow is only an escrow. It is not a sunk cost. As I mentioned, his cap does expire in the middle of 2023. So our advice to him was, let's continue to drive cash flow. And even if rates do not come down at all, we'll be in a better place to potentially refinance into something fixed rate and prevent that cap from becoming a sunk cost. That is his goal overall, is to try to recapitalize, pull some money out. But like I said, right now he's in a bit of a cash in position, hoping if anything to be able to find him to a cash neutral position and put him into something with a fixed rate, with a flexible prepayment, not locking him in long term, but getting him out of this floating rate environment and also the potential for this sunk cost of this rate cap. So there's not a perfect answer. It's always worth analysis. The answer may be to stay in your floating rate deal and to purchase that rate cap, but just wanted to reach out, keep in mind, keep an eye on those expirations. Those escrows could be coming and they could be substantial. As always, feel free to reach out to anyone at Aline Capital if we can be of any help on your investment sales or your capital markets activities for commercial real estate. Thanks.